Well, ladies and gentlemen, welcome back from our short break. I hope you enjoyed the first sessions this morning. You're certainly in for a treat over the next 30 minutes as we share an exclusive sneak preview of Aon's 2021 Global Risk Management Survey results for Australia and the Asia-Pacific region. I'm delighted to facilitate the session today, and it gives me great pleasure to introduce my Aon colleagues, Bruce Gordon, Managing Director of Global and Corporate here in Australia, and our new Aon Australia Chief Executive, Jennifer Richards. Welcome to you both, and thank you for taking us through these exciting survey insights. So before we get into the results, perhaps I can provide a little bit of background on the Aon Global Risk Management Survey. Some of you may remember this goes all the way back to 2001 in Australia when we launched this initiative. But since 2007, the Aon Centre of Innovation and Analytics has conducted the biennial web-based global survey designed to identify the key risks and challenges that organisations are facing across the globe. The survey gathers insights from risk managers, chief risk officers, chief financial officers, treasurers and others on their insurance and risk management choices and concerns. Our Aon analysts then draw insights from the data about the risk environment, looking closely at the top risks, emerging risks, total cost of insurable risk, risk management functions, and more. This year's survey results are informed by responses from 2,344 risk decision makers from small, medium, and multinational organisations around the world. The results come from over 60 countries. The top 5 industries represented in the survey responses are shown on the screen and include industrials and manufacturing, food, agribusiness and beverage, energy, utilities and natural resources, construction and real estate, and financial institutions. In Australia, we captured 121 responses across various industries, with the top represented industries being public sector, energy, utilities and natural resources, financial institutions, construction and real estate, and retail and consumer goods. So thank you to those people who are on the platform attending the Insight series today that actually submitted a response to the survey. We appreciate your feedback. Over 80% of our responses from key risk decision makers include risk managers, insurance managers, general business managers, chief risk officers, finance managers, and of course, CFOs. Our responses also capture feedback from a range of different types of organisations. These include private companies, public companies, not-for-profits, and government, as well as government-owned corporations. So I hope that provides you with a little bit of context around some of the 2021 survey response demographics. I'd now like to hand over to Jennifer and Bruce to reveal this year's top 10 risks for Australia and to talk us through some key movements and developments since 2019. So Jennifer, it looks like there's a new kid on the block in the 2021 results.
Thanks, Jason. Indeed, there is. We certainly expected to see pandemic risk rank highly, but it's really surprising that it only came in at number 9 on the survey. For more than a decade, the risk of pandemics laid buried at the bottom of Aon's risk list, despite the constant threats of bird flu, SARS, Ebola, and Zika. Experts at Aon have repeatedly called out that pandemic is an underrated threat. Fast forward then to COVID-19. Unlike a typical crisis that takes a linear path to its conclusion, the COVID-19 pandemic has played out in multiple waves and interconnectivities that have combined to amplify its impacts. Pandemic risk has acted as a catalyst and magnifier of other risks on the top 10. For example, remote working required companies to bring forward their transition to a digital at scale model by 2 to 5 years. This, in turn, has magnified related cyber, business interruption, and supply chain risks. The ranking of pandemic in the bottom of the top 10 perhaps reflects a somewhat naive sentiment that this is a once-in-a-100-year event that's nearly past. As we heard from Professor Harper today, there's certainly going to be some lingering effects. And a few thoughts on that. The UNESCO report from late 2020 warns that future pandemics will emerge more often, spread more rapidly, and they're going to do more damage to the world economy and kill more people than COVID-19, unless there's a transformative change in the global approach. The The cost of risk reduction to prevent pandemics is actually 100 times less than the cost of responding to them. This will require a deep reassessment of the practices leading to biodiversity loss, climate change, and the emergence of pandemics. I think it's really dangerous for businesses to surmise that we're out of the woods. It underlines the need for companies to improve their pandemic response plans and business continuity frameworks, as well as examining the interdependence of pandemic and ESG risks, which I'll talk about a little bit later this morning as well. Great, thanks for that, Jason. On to this next slide here, cyber. It's described as another epidemic. Sorry, if I can move now to the next, another poignant shift in risk focus. Also likely to be of no surprise to anyone. And that's our #1 risk concern in Australia this year, cyber. Notably, the sharp move of cyber from the 5th position to 1st in the course of 2 years. This speaks to the pervasiveness of the risk. In fact, cybersecurity is perceived as a top 10 risk by every surveyed sector and for all job roles, including CFOs, CEOs, and their chief people officers. This is described, as I mentioned a second ago, as another epidemic. Cyber risk is even more damaging than the lending and liquidity risk that led to the 2008 global financial crisis. Hackers and criminals have exploited the COVID-19 pandemic and escalated their attacks on every business sector in many countries across the world, and Australia is certainly no exception. The sheer number of cyber crimes broke all records in 2020. Aon's 2021 cyber risk report reported that ransomware attacks grew by up to 400% from 2018 to 2020. Australian organizations have become acutely aware of the severity of these attacks, as we've seen businesses literally brought to their knees overnight, with some never to recover. Failure to appropriately assess, quantify, and transfer your cyber risk is also the root cause of many of the other risks in the top 5, which we'll talk about today, notably brand and reputation, business interruption, legislative changes, just to name a few. I'm going to now hand it over to Bruce to walk us through some of the other interesting movements in the top 10 results for Australia.
Thank you and good morning, everybody. As you can see, we have the results for Australia here, correlating 2019 with 2021. And as you can see, brand and reputation risk has slipped over that 2-year period, but as it comprises a drop from #1 to #2, I don't think particularly material. What I'm going to do instead is focus on a couple of nuances. The first is the difference in risk perceptions between geographies, a theme to which I will return later. And secondly, in relation to some of the findings of more recent research undertaken on behalf of Aon by Pentland Analytics. So first, the geographic discrepancies. I think it's a really interesting point. As Jason said, this form of report has been in existence for 2 decades, since 2001. And in every iteration of the global study, brand and reputation risk has ranked higher in Australia than any other single territory in the world. And it's also the case that it has been consistently, across that entire period, a top 3 risk, whereas in the rest of the world, in the GRMS sample, it's generally been top 5. So clearly, brand and reputation risk, it lies heavily on people's minds as an influencer of business performance. If I move briefly to the Pentland Analytics research that Aon has commissioned over many years, I think there's a couple of issues that I'd like to highlight. In relation to the 2019 report, that compared the incidence and severity of brand and reputation risks in the pre-digital and post-digital world. Now, nowadays, everyone's got a smartphone, everyone's got a tablet, and as a result, everyone's a broadcaster. They have media access and they can get their opinions out quickly. And so it wouldn't surprise anyone to understand that the incidence or frequency, if you like, of brand reputation occurrences is on the increase. But what was particularly interesting around the 2019 report, I thought, was that it also climbed into the severity aspect and the amplitude, the difference between the losers who did not recover from an occurrence and the winners was markedly increased. If I turn briefly to the 2021 report, it was actually titled Respecting the Grey Swan. And this I also thought was a very informative and useful examination of the brand and reputation phenomenon, because what it concentrated on was not the black swans, the complete outlier events, but rather, if you like, the middle quartiles of brand and reputation occurrences, the known unknowns or the unreasonably foreseeable, if you like. And even at that lower level of severity, the report made explicit the extent to which brand and reputation risks can erode enterprise value. And when you think about it, it's not a huge surprise, because at the end of the day, brand integrity underpins brand equity, and brand equity is one of the foundation stones of enterprise value. What I'd like to turn to next is another of the risers, if you like, in the GRMS 2021, and that is, in Australia in any case, the failure to attract and retain top talent. Now, this is probably being experienced by every manager from every sector and every organization on this call right now. This is a hot war, it's not a cold war. And I don't know where the expression "the Great Resignation" came from. It might have been Harvard Business Review, it might have been Forbes, it might have been somebody else. But unfortunately, those two organizations, their prognosis is the hot war for talent, which people are experiencing right now, is going to continue through to 2022. I mentioned earlier on about how brand and reputation risk can impact enterprise value. In relation to enterprise performance, the same very clearly applies to attracting and motivating and retaining talent. These are critical arbiters of enterprise performance. And that's reflected in the increase in ranking between 2019 and 2021, which you can see in the slide in front of you. Unfortunately, like most risks, this is a complex issue. It isn't binary. Because how you attract talent, how you motivate talent, how you retain talent is almost as important as the talent you hire. Because how people behave ultimately underpins organizational culture and risk culture. And organizational culture and risk culture, in turn, ultimately underpin and go to the very root of long-term business sustainability and business resilience. I'm now going to hand back to Jennifer to offer a few more insights.
Great. Thanks so much, Bruce. I'm going to speak for a minute now just on the increased competition factor. So whilst increased competition has consistently been a top 10 risk since we launched our survey in 2007, this year it's surprisingly dropped to 10th from 4th, which I put down likely due to the heightened perception of other risks, such as business interruption, commodity price, and scarcity of materials, as well as slow economic growth. We have seen a diminished focus on traditional competition, as organizations focused on addressing COVID-19 affected trading. It's going to be interesting to see how this develops over time as we move past the lockdowns, which we've spoken about today. In particular, as organizations wage the intense war for talent that Bruce just referred to. I think the companies that are able to cater to the changing needs of workers in the post-pandemic world could certainly take the spoils. Back to you, Jason.
Thanks, Jennifer and Bruce. Some very interesting movements there in the top of mind risk concerns for Australian organisations. So let's now take a look at the top 10 risks from a regional perspective. Bruce, do the results show notable similarities or perhaps differences between the Australian top 10 we've just covered and the Asia-Pacific top 10?
Rather unhelpfully, Jason, they exhibit both. So what I'm going to do is just try and highlight some material differences, which you can see in the slide in front of you, and say I will concentrate on the three starkest differences in respective regional top 10s. And again, as Professor Harper pointed out so eruditely earlier on, these phenomena are interlinked. Risk is fungible, risk is fluid, and it's heavily interconnected. So Jennifer talked about pandemic risk a little earlier on in relation to Australia. You will see that pandemic risk in Asia Pacific ranks materially higher. Now, if you look at the economic, social, and human cost, particularly the latter, of the COVID crisis in Asia Pacific, I don't think it takes a huge amount of imagination to understand why it would rank materially higher in Asia Pacific than was actually applies to the economic slowdown. I mean, Professor Harper alluded to the fact that in 2020, Australia suffered its first technical recession in 30 years. And even that, in the context of the noise around COVID, was somewhat muted. Now, again, if you look at the social and economic impact of the COVID recession on Asia, that higher ranking in terms of risk perception absolutely makes sense. And finally, in relation to business interruption. Business interruption is really a subset of supply chain risk. And again, supply chain risk was referenced by Professor Harper and is also separately addressed in GRMS. Without wishing to appear flippant, probably the most great and most proximate incidence of supply chain risk in Australia right now is the inability to buy the automobile that you want, or the car with the specification you want, or the smartphone that you're seeking. If you compare that with parts of Asia, business interruption and supply chain risk actually manifests as food insecurity. And put it at its most basic, that means not having enough food to put on the table. So I think from the point of view of the relativity of all three as between Australia and Asia Pacific, absolutely there are differences, but in terms of the rationale which underpins those differences, I think they're fairly easy to understand.
Thank you, Bruce. Thanks for sharing those thoughts. Bruce mentioned supply chain, which is a relevant point. Tomorrow, we're going to go through an international case study with Toyota, and you'll hear a fascinating story about how they built resilience into their supply chain. So, stay tuned for that case study tomorrow. But it has been great to examine the data from a number of different angles here today. So just moving along with the results here, let's have a look now at some industry differences amongst the data itself. And Jennifer, perhaps I can pass over to you now to take us through some of the key risks that we see across industries and how those vary.
Great. Thanks, Jason. Indeed, there are some really interesting variations when we put an industry lens on. We've highlighted here the top 10 risks for public sector, energy, utilities and natural resources, construction and real estate, and financial institutions. What jumps out first and foremost to me is climate change. As you can see, it's ranked at number 2 for the energy, utilities, and natural resources sector, but it's notably absent from all others. Whilst elements of climate change may certainly come up under certainly other factors, including regulatory and legislative changes, it's really interesting that this prominent and urgent risk is not top of mind more broadly. We know from recent research, such as the IPCC report that was recently published, that climate change will continue to have significant impacts that businesses across all industries need to be planning for. For example, extreme weather can have substantial impacts on global supply chains, put great stress on infrastructure, and add strain to insurers and other financial institutions, so thereby impacting all kinds of industries. There are also transitional risk considerations that are associated with decarbonization, in particular decarbonization strategies. We certainly expect to see climate change risk make its way up the ladder in future surveys. We have a session in our program tomorrow that looks at climate change risk modeling, and I really encourage all of you to attend that to certainly shed some more light on this issue. I want to now look briefly at the regulatory and legislative changes rankings. It ranks really highly across many of the heavily regulated industries, which seems quite logical. There's been significant government uncertainty in recent years in Australia, and several industries, notably construction, have seen themselves severely impacted by lockdowns. And they're also heavily dependent on government stimulus packages. Interestingly, though, it's fallen out of the top 10 for financial services. Perhaps this is a reflection of being on the other side of the remediation. That's the legacy of the Hayne Royal Commission. But imagine there'll be more to see on that going forward as well. Finally, I just wanted to take a look at cash flow and liquidity risks. It's unsurprising to see cash flow appearing in the top 5 for financial institutions. The economic impact of COVID-19 continues to linger, with organizations impacted by reductions in revenue, business disruptions, supply chain issues, delayed customer payments, and increased operational costs. These have all interfered with cash flow and liquidity. This is having a major impact on financial institutions' appetite to lend, and consequently restricting the access to capital for many industries. This risk does not appear in the top 10 for construction, likely due to the government's focus on infrastructure investment to help revive the industry following a dip in 2020 due to COVID. Back over to you, Jace. I think you're still on mute, Jace.
Thanks, Jen. Some really interesting observations from an industry perspective there. So now let's move on to total cost of insurable risk. Bruce, we know measuring and managing total cost of insurable risk has proven to be one of the most effective ways to evaluate an organisation's risk management strategies, particularly in a hard insurance market. What are the Australian results from the 2021 survey telling us about organisations' approaches here?
Well, first of all, as you can see from the exhibit in front of you, there are 4 parameters which describe TCOR. One is risk transfer, one is risk retention, another is external risk management costs, and the other is internal risk management costs. And just because of the audience we've got on this web today, I think the last one, the internal risk management costs, is probably the one that's underplayed and underclubbed in every survey, because it's hard to identify, it's hard to quantify, and generally it gets lost in the noise. And if we look at the risk transfer element of the bar chart, you can understand that. Because whereas risk transfer isn't an exact proxy for insurance cost, it's a pretty good proxy. And you can see that 88% of the audience who responded to GRMS, in fact, I'm amazed it's as low as that, have experienced an increase in their risk transfer costs. Now, as I say, that is not a surprise, because over the last 4 decades of hard markets, this is probably the hardest of the lot, simply because it's lasted longer, 3 to 4 years already, it's affected all lines of business, and it's affected every geography around the world. And the other thing that this hard market has highlighted, and I'm afraid this is just a cruel reality from all other hard markets, is that insurance is counter-cyclical. And what I mean by that is, when clients are least able to afford insurance and most need it, it's most expensive and most constrained. Now, conversely, our advice to clients in terms of how to manage their way through the insurance cycle actually doesn't address the insurance cycle at all. Rather, what we say consistently to clients is this: forget about insurance and markets, think about enterprise risk and your business. Then understand your organizational risk tolerance. And what I mean by that is your organization's appetite for volatility across sequential review periods, which is attributable to all forms of risk, not just insurable risk. The third element is then to quantify your insurable risk appetite. That is the amount of insurable risk which you could transfer, but which you are electing to retain as a component of organizational risk tolerance. And when you have those big box issues resolved and clarified, you'll be in a much better position to engage with insurance markets irrespective of the cycle, and in so doing, modulate your purchase accordingly. Back to you, Jason.
Thanks, Bruce, for those insights. So let's just move on to the last area now before we go to Q&A. And this is a topic of increasing focus and concern for organisations all around the world. It's the topic of environmental, social and governance. otherwise known as ESG. Jennifer, what are the results showing in terms of how serious Australian businesses are about their ESG approach?
Great. Thanks, Jason. I spoke a little bit earlier about the interconnection between climate change, pandemic, and ESG risks. Given that ESG is such a prominent and urgent issue for all organizations now, it's really interesting to see that ESG is not rated in the top 5 emerging risks on our survey this year. ESG strategies sit at the very heart of most businesses' plans today. And with these strategies comes new risk. Companies are increasingly required by regulators to adopt transparent and effective ESG initiatives. The underrated status of this risk could be attributable to the fact that many participants classify ESG to be predominantly a regulatory exposure today, or a driver of reputational damage, both of which feature in the top 10 list. So that's one way to explain it. But it's also really interesting to see the disconnect between the stated importance of ESG and what is reflected in CapEx. This demonstrates perhaps a disconnect between the public face versus the private mind, or perhaps the lag between intention and action. Consumption choices need to be made, which can present really difficult resettings of priorities for organizations in such a short period. And we might just be in that lag period right now. Regardless, though, we can safely predict that ESG and climate change will become the next big focus for companies and enter the top rankings in future surveys. We've got a really great session planned later this morning to highlight how ESG can serve as a critical lever to long-term growth. So I really hope our audience can join us for that session too, Jason.
Great. Thanks, Jen. So now we can move on to our second audience poll of today. We really want some feedback from you, our clients. But firstly, thanks to Jen and Bruce for taking us through some of those key findings. So you'll see a question come up on your screen in a moment, and we'd really appreciate it if you could pop in your anonymous response. It would be great for all of us in the session today to see how prepared you feel your organisations are to manage emerging reputation, social and environmental risks. A request to our Aon colleagues and insurance carrier partners again, please, who are listening to the event. Could I please ask you to refrain from answering the poll so we can focus on the client data only? Okay, so let's now move on to the poll. And the question is, how prepared is your organisation to manage emerging reputational, social and environmental risks? Are you, number 1, not prepared at all? Number 2, somewhat prepared? Number 3, prepared? Number 4, better prepared? Or number 5, very prepared? So can I please have your answers in the boxes there, please, and put your responses in, and we'll put those up on the screen in a few moments. And just for everyone's information, these surveys we're running at each of our events, we're going to consolidate at the end of the Aon Insight series across our 4 events, and we'll play these back to you so you can see the global perspective as well as our local perspective here across the Pacific today. Okay, so we've got most of the results in here. I'm going to put these up and show them to you. Some good responses. And what is this telling us here? Well, interestingly, very few people are not prepared at all. That's what we would expect. 47% somewhat prepared, 27% prepared, and close to 20% better prepared. Only 1.5% saying that they are very prepared, which is very interesting. So thank you for your feedback. And as I mentioned, we'll play that back to you via some feedback at the end of the series when we can tabulate global results. So we now have a few moments to take some questions from the audience around the data points we've shared. Please go ahead and submit your Q&A questions if you haven't already, but I do have a couple that have come in already. And Jen, I'm going to pass the first question to you. And that question is, what do you think will be the number 1 risk for Australian businesses in 2 years' time?
Yeah, I think the ESG and climate risk factors are definitely going to be up there, Jason. And I think that poll actually just demonstrates why. Clearly, it's moved so quickly up the agenda for most organizations, but that there's still this lag around preparedness. So I imagine that will be in the top 5.
Right. Thank you, Jen. And Bruce, a question for you on a topic I know you're passionate about, and we saw that in your response before, around total cost of insurable risk. Bruce, the question is, do you think total cost of insurable risk will continue to increase, or do you foresee it plateauing moving forward?
Well, I actually might defer my answer to Ben Rolfe, who's running a market outlook session as part of AIS. But from a personal perspective, Jason, is it the end of the beginning? Is it the beginning of the end? I think it's a moot point, but hard markets resolve themselves. They resolve themselves by new capital entering the market, seeking an attractive return from uncorrelated risk. And sure as eggs, that's going to happen. The precise timing, none of us know, but it is going to happen. Capacity will be unconstrained or less constrained. Coverage will revert to prior state or part of prior state, and so will pricing. And all of us, particularly the audience on this call, must be looking forward to that happy day.
Great. Thank you, Bruce, for that response. And as Bruce mentioned, stay tuned for tomorrow morning, the address on the market from our Chief Broking Officer, Ben Rolfe. So let's now just move up to wrap up these morning sessions. We've reached the end of our time for this specific session. And special thank you to Jennifer and Bruce for your perspectives today and for sharing some of the key Australian results from Aon's Global Risk Management Survey for 2021. This was a sneak preview. What we showed you has not been shown anywhere else in the world yet and won't be for the next 6 or 7 days. So we hope these regional and industry-specific insights help you, our audience, to better manage volatility, address and reduce risk, and to realise opportunity. The full global report, as I mentioned, will be launched next week, so keep an eye out for that when it hits your inbox. So coming up, just getting ready for the sessions after the break, we've got 2 more wonderful sessions to round out day 1 of the Aon Insight series. Please join us firstly for a deeper look at ESG as a critical lever to long-term growth. And then after another short break, I'll be back with 3 of Australia's outstanding business leaders who'll discuss the importance of building workforce resilience and the role well-being programs can play. We really hope you can join us after the break and look forward to seeing you return shortly. Thank you.